Imagine a scenario where the stock market is so heavily weighted towards a handful of tech giants that a single misstep could send ripples through the entire financial ecosystem. This is the reality we're facing today, as the top 10 companies in the S&P 500 now count for a staggering 40% of the index, marking an unprecedented level of concentration. But here's where it gets controversial. While this concentration can amplify gains, it also magnifies the risks, especially when most of these top players are in the tech sector. According to data from Morningstar, the current makeup of the S&P 500 is more skewed towards its largest components than ever before. The top 10 stocks, which are predominantly tech-focused, now represent nearly half of the index's value. Dominic Pappalardo, chief multi-asset strategist at Morningstar Wealth, warns that this concentration could spell trouble if these tech giants stumble. The top 10 companies are so interconnected that a downturn in one could trigger a domino effect, Pappalardo explained. If even a couple of these tech leaders report disappointing earnings, it's likely that all of them will take a hit, potentially causing a significant sell-off in the broader market. To put this into perspective, consider the post-Liberation Day sell-off in April, where these same tech stocks were among the hardest hit. Given that the S&P 500 is currently near record highs, Pappalardo suggests that a market pullback might be on the horizon. However, he emphasizes that while a recession isn't necessarily imminent, there are other threats that could derail the market's upward trajectory. One such threat is the weakening labor market. Recent job reports have shown historically weak employment growth, particularly in May, June, and July. The next crucial piece of data will come from the Bureau of Labor Statistics' September 5th payrolls report, which will provide further insight into the health of the job market. If the trend continues, it could compel the Federal Reserve to resume rate cuts, a move that has generally been welcomed by investors. But here's the catch. Rate cuts might not be enough to sustain the market if the underlying economic fundamentals, like job growth, remain weak. Another looming concern is inflation, which has remained stubbornly high, with the Consumer Price Index, CPI, rising 2.7% year-over-year in July. The Fed's preferred measure, the Core Personal Consumption Expenditures, PCE, also saw a 2.9% increase in the same period. Tariffs have played a significant role in driving up prices, and if inflation continues to rise, the Fed might be forced to keep interest rates high, which could slow down economic activity. Tariffs have undeniably increased costs for both businesses and consumers, Pappalardo noted. This is a clear and present danger that could further complicate the economic landscape. Given these risks, Pappalardo recommends diversifying portfolios to mitigate the overconcentration in tech stocks. He suggests adding exposure to international markets, small-cap stocks, and the healthcare sector, which offers strong earnings potential and relatively low valuations. And this is the part most people miss. While the tech-heavy market can offer substantial rewards, it's crucial to balance this with a diversified investment strategy to protect against potential market volatility. What do you think? Is the market's heavy reliance on a few tech giants a cause for concern, or do you believe these companies can continue to drive growth despite the risks?